Thanks for clicking. Canadian mortgage rates were up all across the board on Tuesday, due in large part to the actions taken by Britain's newly elected Prime Minister Liz Truss.
What?
Indeed, few were expecting it, but bond yields, and soon thereafter mortgage rates, were up all across the US and Canada on Tuesday in response to rising yields in the UK. By the end of the day on Tuesday, Canadian mortgage rates were up about 30 basis points or 0.3%, and mortgage rates in the US were fast approaching 7%. Given that mortgage rates barely moved, in fact they didn't move, following the Bank of Canada's decision to raise interest rates by 75 basis points at the beginning of the month, why did they move following something that happened thousands of miles away in England? What I want to do today is briefly go over bond yields, take a look at the actions taken by British Prime Minister Liz Truss, how those actions led to rising mortgage rates in Canada, how the situation was resolved, and take a look at the implications for the future. As we'll see today, central bank monetary tightening is a fickle beast and can have cascading implications across countries. We'll continue to monitor the actions of Canada's central bank, the Bank of Canada, on this channel and its implications for the Canadian economy going forward. Click like and subscribe if you want to get those updates, but for right now, let's get into bond yields. Very briefly, a yield is how much money can be made from a government bond, a promise to pay. So if the government sells a bond for the price of $100 with a 1% interest rate, they are promising to pay that bondholder $101 at the time of maturity. So the bondholder is yielding 1%. They're profiting 1% on that $100. But let's say you own that bond and you don't want to wait until maturity. You want to sell it now. So you sell it to your friend for $95. You get the $95 in your pocket, and your friend gets that bond that will one day yield them $101 for only $95. So on that $95, they are yielding a little over 6%. They paid $95, they're getting $101. They are yielding $6. So as the prices of bonds go down, the yields or the amount of money being made on those bonds goes up. So what happened in the UK? Amid crushing inflation of 9.9%, the government of Prime Minister Liz Truss announced that they would be cutting taxes, the biggest tax cut Britain has seen since 1972. So while the central banks of the world are trying to get money out of their economies, trying to pull the money back, essentially cause recessions, the UK government instead decided to cut taxes to provide stimulus for the UK economy. The tax cuts were not very well received by UK bond investors, which, given the anticipated higher than 9.9% inflation that was sure to follow the tax cuts, began to sell off UK bonds, or gilts. If I'm a bond investor and I have a UK bond yielding, say, 2%, but I know that inflation is going to be going up to 15%, I'm not going to wait for that bond to mature. I'm going to sell that bond now. Get my money out before the currency is debased, before the currency falls even more. And I'm going to put my money elsewhere. And then I'll wait until the central bank, the Bank of England, has to raise rates to fight that inflation, and I'll buy those bonds. I'll buy those bonds that are going to yield me even more money. And when everyone sells at once, when everyone wants to get rid of their gilts at the same time, this causes prices of those gilts, of those UK bonds, to plunge, which causes yields to skyrocket. Rising yields in the UK shook the market, causing investors in US bonds to also demand a premium, and you guessed it, US yields shot up as well. And given that, for right now at least, US Treasuries are considered the safest debt in the world, as yields on the US bonds went up, so too did demand for the yields on Canadian bonds, and the yields on our bonds shot up as well. So as the amount of money that can be made on a Canadian bond shot up on Tuesday, so too did mortgage rates, rising to 4.79, which, as we discussed less than a week ago, we're sitting at 4.49, relatively unchanged for the past few months, despite the Bank of Canada raising interest rates. So, from Prime Minister Liz Truss to the UK bond market, to the US bond market, to the Canadian bond market, all the way to a higher borrowing cost for the average Canadian homebuyer, all in the period of a couple of days. Yields in the UK have since fallen after the Bank of England announced it would be intervening in the market, buying up long-term bonds. So the Bank of England is essentially restarting another round of quantitative easing. essentially setting a price floor for bonds, saying they will not allow UK bonds to be sold below a certain price. At a certain price, they will buy an unlimited amount of bonds using printed money.
You mother.
Created money. So while yields have moved back down in the UK and as such in the US and in Canada, though mortgage rates remain unchanged,
You mother.
the Bank of England is the first central bank to retreat back to quantitative easing once something goes wrong. This is a stark reminder that the bond vigilantes are back, and rightly or wrongly, under the current system, governments can't spend however they want without serious implications, without serious consequences. Following the massive surge in UK bond yields, there was a record number of banks pulling their mortgage offers from clients, which would have created a real problem for the British financial system had the Bank of England not intervened in the crisis. And I think the Bank of England's actions speaks volumes as to what we can look for next. One of the things we've talked about at great length on this channel is what will the central banks do? What will the Bank of Canada do if something breaks as a result of the monetary tightening, as a result of the rising interest rates? If a too big to fail institution, if a too big to fail bank starts to fail as a result of these interest rate hikes, will the central banks reverse course? Will they engage in another round of quantitative easing? Will they engage in another round of interest rate drops? Will the central banks lower interest rates while maintaining skyrocketing inflation? Or will they remain tough on interest rates? Will they remain tough on monetary policy and let whatever's breaking break? The Bank of England, the BOE, says this round of quantitative easing is temporary, but everything is temporary until it's not. With that said, we'll continue to monitor global events and how they have an impact on the Bank of Canada and, of course, Canada's economy and its real estate market. Click like and subscribe if you want to get those updates, and thanks so much for watching.